Welcome back, students and scholars. In this episode, we are covering ASC 255 Changing Prices. This is a short topic, but it carries one very useful reporting idea. Financial statements may show historical numbers, while the economy around those numbers keeps changing. Our goal is simple: understand how inflation, purchasing power, current cost, and supplementary disclosures help users read financial statements with better context. No overcomplication today. One topic, one core subtopic, and one main message. Let us start with the problem. A balance sheet amount recorded years ago may still look stable, but economic reality may not be stable. A machine bought for $500,000 may cost much more to replace today. A fixed loan may become easier to repay when dollars lose purchasing power. Historical cost gives discipline and evidence, but it does not automatically adjust old numbers for inflation. The ledger records the past. It does not wake up every morning and check the price level. Now, look at where this topic fits in the broader US GAAP structure. ASC 255 is not a recognition or measurement engine like revenue, leases, or intangibles. It does not tell us when to record an asset or liability. It sits closer to presentation and disclosure thinking because its purpose is to add changing price insight around the primary statements. So remember this placement. The primary financial statements remain the main report, and this topic gives supplementary inflation perspective around them. This topic is narrow by design. ASC 255 has one main subtopic, ASC 255 10 overall. That is good news for students because we do not need to build a large framework with multiple recognition gates. The guidance focuses on reporting the effects of changing prices on financial information. It covers general price level changes such as inflation and specific asset price changes such as current cost. Keep the memory sentence simple: one subtopic, one purpose, inflation context for users. The scope is also easy to understand. This guidance is relevant to business entities preparing US GAAP financial statements, and it also has a foreign operation angle where highly inflationary economies are involved. But the most important exam trigger is the word encouraged. Changing price disclosures under this topic are encouraged, not required. So, if a question asks whether omission of this supplementary information is automatically a gap violation, be careful. Encouraged does not become mandatory just because the question sounds serious. Now, let us fix the baseline before adding the inflation lens. Historical cost means amounts are generally based on the original transaction price. For example, if a building was purchased years ago, the accounting records begin from that purchase price and then apply the relevant US GAAP rules, such as depreciation where applicable. This basis is useful because it is objective and verifiable. Its limitation is that in an inflationary environment, it may not fully communicate today's replacement pressure or the real comparability of older amounts. Constant purchasing power solves a different problem. It says that dollars from different periods may not have the same buying strength. So, amounts can be restated using a price index, commonly the consumer price index for all urban consumers, to express them in units with the same purchasing power. This does not rewrite the original transaction, it changes the measuring unit so that users can compare amounts across periods more meaningfully. Think of it as putting old dollars and current dollars on the same scale. Now move from general inflation to the current cost view. Current cost asks what it would cost today to acquire or replace the same or an equivalent asset. That is asset specific. It is not just a general price index adjustment. Also, do not confuse it with fair value under ASC 820. Fair value is generally an exit price idea from a market participant perspective. Current cost is closer to an entry price or replacement cost idea. Same asset, different lens, different purpose. Monetary items behave in a special way when prices change. Monetary assets are fixed money claims such as cash, receivables, and fixed dollar notes. During inflation, they can lose purchasing power because the same amount buys less. Monetary liabilities are fixed obligations such as payables, loans, and bonds. For a debtor, inflation can reduce the real burden of repayment, creating a purchasing power gain. This feels a little upside down at first, but that is exactly why exam questions like it. The foreign operation angle adds currency translation to the inflation story. Under a restate translate approach, the local financial information is first restated using a local price index and then translated into the reporting currency. Under a translate restate approach, the amounts are first translated and then restated using a reporting currency price index. At this level, focus on the difference in sequence, not calculations. Also recognize the related terms parity adjustment and translation adjustment. The slide is a map, not a calculator. Now log the three main traps. First, encouraged does not mean required. Second, supplementary changing price information does not replace primary US GAAP statements. Third, current cost is not the same as fair value. Most errors in this topic come from mixing labels, not from difficult math. Sometimes accounting is not trying to trick you, it is simply checking whether you respected the exact word on the page. Let us answer the first short answer question. Why does this topic matter if historical cost statements are still used? A strong answer is historical cost reports past transaction prices, but changing prices can affect how users interpret assets, profit, and financial position. Supplementary changing price information gives inflation context without replacing the primary statements. Keep the answer balanced. Do not attack historical cost and do not overstate the role of supplementary disclosures. The standard adds context, it does not rebuild the financial statements. The second short answer question asks about constant purchasing power versus historical cost. Historical cost keeps amounts in original nominal dollars from the transaction date. Constant purchasing power restates those amounts using a price index so that different periods are expressed in comparable purchasing power units. The key exam phrase is measuring unit. The underlying asset or transaction has not changed. The reporting lens has changed so that users can compare old and current amounts more fairly. The third short answer question is the most direct. Are changing price disclosures required under US GAAP? No, they are encouraged, not required. They are supplementary information that may be provided alongside the primary financial statements. They are not a normal required section on the face of the balance sheet, income statement, or cash flow statement. So the clean exam answer is this. Omission of these disclosures does not normally create a departure from US GAAP. Read the word encouraged carefully. Let us close with the memory map. ASC 255 is a narrow topic with one core subtopic. ASC 255 10 overall. Historical cost remains the primary baseline. Constant purchasing power adjusts the measuring unit. Current cost gives an asset specific replacement cost lens. Monetary assets and liabilities can create purchasing power losses or gains during inflation. Most importantly, the disclosures are encouraged, not required. If this lesson helped you, please like the video, share it with your colleagues, subscribe to Commerce Regiment, and support the channel. In the next topic, we move to ASC 260, earnings per share, where income numbers meet share count logic.